Today we're looking at RSI, or Relative Strength Index. Look at what it is, how it works, and how you can take advantage to make your trading strategies more profitable. So what exactly is RSI? Well, for those that like maths, the formula's on screen, but I don't want to overcomplicate this. What we're looking at here is really an indication of gains versus losses. This is what we call a momentum indicator. So this is going to tell us whether there's strength in the market or whether there's weakness. So if we're in a bullish period with more bigger green candles, we're going to end up with a larger number of average gains than average losses, which is going to come out at a higher net RSI. And conversely, if we're in a period with sustained downward momentum, we've got more bigger red candles, then what we're going to see is a reflection in the larger number of average losses than average gains, and this overall RSI number is going to come out much lower. And this concept is really key for us to understand, because armed with this knowledge, we can take advantage in the market. So how can we use this to boost our profitability in trading strategies? There are two key ways to use this indicator. The first is trend identification, to understand whether we're in an uptrend or a downtrend, whether we've got a bull market or a bear market or a sideways market. The second is entry and exit signals. So using this to understand when we should get into our trades and when we should get out of them, particularly for swing traders that are looking to catch short-term momentum swings. And for me, because I trade algorithms, I need to be able to clearly define my entry and exit rules within my strategy. So let's dive a bit deeper into those two. How can we use the RSI to understand whether we're in a bull market or a bear market? And the key thing to do here is look at the long-term average of the RSI. So you can see here in this chart, I've set my RSI to 250 periods. So we're looking at the last 250 days worth of RSI within this particular chart. And you can see here we're in a sustained bull market all the way along this chart, and the RSI is sticking above the 50 mark into that 50 to 70 kind of range. Remember, our average gains over that period are larger than our average losses. So the long-term RSI is above 50. So that's a good marker for us to look at. So if we're looking for a signal of a bear market or a downtrend, then remember the average losses are going to start to outweigh the average gains, and that number is going to push down below the 50 marker on the long-term average. So that's my first tip for you, using the long-term RSI and working out whether we're above 50 or below 50. So how can I build that into a trading strategy? Well, you can have a sneak peek at one of my algorithms here. You can see that I've put in rules to check whether the RSI over the long term is above or below its moving average, and whether it's above or below 50. In particular, on that 250 part range, that's personal preference. You don't need to follow it. That's just an example of how it can be used. So the second thing we talked about was entry and exit triggers. As the price bounces up and down, you can see the RSI oscillating between high and low levels here. And that's what a lot of swing traders will try and do. They'll try and sell when the RSI gets above this 70 range, and they'll try and enter back in when it drops down below the 30 range. This can be a really effective strategy, particularly in a sideways market when the price is just oscillating between two support and resistance levels. As a long-term strategy, you need to be really careful. You could miss sustained gains or sustained losses. Remember, the price doesn't always swing back immediately. If you sell when the RSI gets over 70 and then over a prolonged period the average gains continue to outweigh the average losses, you're going to miss out on all these potential gains. Similarly, if you've got a strategy that just buys when the RSI falls below 30, and then we enter a period where there's sustained momentum downwards, i.e. the average losses are going to continue to outweigh the average gains, then you're going to be sitting on all these losses down here until the RSI eventually swings back. So you can't just rely on it alone. You have to combine it with other indicators to identify the direction of the market. So again, if I give you a sneak peek of one of my own algorithms, I've got a really simple section that just says, is the RSI above or below certain blocks? And I combine that with other conditions to trigger buy or sell orders. So there you have it. Relative Strength Index is just a measure of average gains and average losses. It's useful to identify whether we're in an uptrend or a downtrend, and it can be used for entry and exit triggers. It shouldn't be blindly relied upon though. It should be combined with other trading indicators, and used correctly, it can boost your profitability and your trading strategy. Hopefully this has been helpful. Check out some of my other videos for more insights. Until then, see you next time and happy trading.